So I want you to imagine you're a senior banker in Luxembourg, right?
Okay, I'm picturing it.
You've just signed this really high net worth client who resides in Paris. And you've vetted their identity perfectly. You ran them through like every anti-money laundering protocol, and you successfully secured millions in fresh deposits.
Sounds like a great quarter.
Right. You shut your laptop thinking, I've done my job flawlessly. But what you've actually done is hand your compliance department and the French regulators a ticking time bomb.
Yeah, that is a surprisingly common scenario.
Today, we are entirely dismantling this myth of the borderless European bank because this deep dive is all about unpacking the hidden regulatory labyrinth of Luxembourg private banks servicing French resident clients.
And that ticking time bomb you mentioned, it really stems from a fundamental misreading of what the European single market actually allows in practice.
Exactly, because, we always hear that capital moves freely, right?
Right, but people assume that because the capital moves freely, the legal framework surrounding the professionals who move that capital is like equally frictionless.
Mm-hmm.
And I mean, it just isn't.
It's the exact illusion we're tackling today because the assumption is usually, well, Luxembourg and France are both core members of the EU. They share a currency, they share borders.
You don't even show a passport on the train between them.
Exactly. So cross-border banking between them must just be this wide-open highway. But when we dive into the actual source material for today, which is a hefty stack of Luxembourg financial laws, French monetary codes, and overarching EU directives, that highway starts looking a lot more like a heavily fortified labyrinth.
A labyrinth where, honestly, a single missing document or even just a poorly documented phone call can unravel an entire client relationship.
Wow. Just a phone call.
Oh, absolutely. And it triggers massive regulatory penalties. So our primary mission today is to translate all those dense legal codes into a clear operational playbook for financial professionals.
And for anyone who's just insanely curious about how this stuff actually works behind the scenes. So let's start with the architecture of this labyrinth. Where does that initial misconception of the borderless bank come from?
Well, the confusion mostly centers around this concept of the financial passport.
Right, because there clearly is some legal mechanism that allows a Luxembourg bank to operate in France. It's not illegal.
No, it's not illegal. It's just restricted.
Yeah.
But a lot of professionals think of an EU banking passport the way they think of their own personal passport.
Right.
You show it at the border, they wave you through, and now you have the run of the country.
But I'm guessing regulators don't view it quite like that.
Not at all. Regulators do not view cross-border finance as a simple binary of like allowed or not allowed.
Right.
It's a highly specific, multivariable equation for them.
Okay, what are the variables?
They want to know exactly which entity is acting, from which specific member state, targeting which specific market, and executing which precise regulated service.
Okay, so it's not a blanket approval at all. It's more like a very narrow, highly conditional visa.
That's a perfect way to look at it.
Because if I'm piecing together the legal foundation from our sources, it looks like a three-tiered system. You've got the bank's foundational license at home, right? So in this case, Luxembourg's Financial Sector Act of 1993.
Yeah, that gives the bank the right to exist in the first place. That's your base layer.
Okay, and then you have the EU passport layer. Those are the directives that actually grant the theoretical right to cross the border. So CRD 4V for traditional credit institutions and MiFID 2 for investment services.
Exactly. But here is where the friction really starts.
Yeah, because the top tier isn't controlled by the EU or Luxembourg at all.
No, it's controlled by France.
Right.
And that dynamic is the source of almost all the compliance failures we see. The host state, so France, retains the right to dictate exactly how those EU passports operate on its sovereign territory.
And they do that through the French monetary and financial code, right?
They do. So even with a perfectly valid MiFID II passport from Luxembourg, a bank still has to navigate Article L 511.22 and Article L 532.18 of the French Code to actually deploy those services in Paris.
It reminds me a bit of driving across Europe. Like, I have a valid Luxembourg driver's license. It's recognized across the EU. I can physically drive my car into France.
Sure.
But the second my tires cross that border, my Luxembourg license doesn't exempt me from French speed limits or French road signs or French traffic laws. Like, if I get pulled over, I can't just argue, well, the speed limit back home is higher.
Right. That analogy validates the concept perfectly. But to capture the real friction of the banking world, we have to push that metaphor even further.
Okay, how so?
Imagine if, before you could even drive into France, You had to submit a detailed itinerary of every single road you plan to take.
Oh, wow.
And you had to declare the exact type of cargo you were carrying and prove you understood the specific traffic laws of every single municipality you passed through.
That sounds exhausting.
And if you deviated from that itinerary by even one street, your license was essentially invalidated for that trip. That is much closer to the regulatory burden we were actually talking about.
That sounds like a complete operational nightmare. I mean, if holding the EU passport isn't enough to just start doing business, how does a Luxembourg bank practically ensure it's not deviating from that itinerary?
It requires a bank to survive this sequential gauntlet of operational checks. And they have to do this before they even think about pitching a client.
Because if I'm a banker, I can't just freeze up every time a French client asks for a new product, right? So what's the first check?
The first wall they hit is classifying the precise nature of the service.
Because different services trigger entirely different regulatory tripwires. A bank isn't just like doing banking.
Far from it. The legal analysis changes completely depending on the specific activity.
Give me an example.
Well, if a bank is merely holding cash deposits, the friction is relatively low. But if they move into Lombard lending, credit secured against a portfolio, or if they start processing complex payments, the requirements shift.
And what if they get into actual investment advice?
Oh, if they step into investment advice or discretionary portfolio management where the bank makes decisions without prior validation, the regulatory burden increases exponentially.
Right, because moving from passively holding a deposit to actively managing a client's wealth carries just infinitely more risk for the consumer.
Exactly. France wants to ensure that anyone selling structured products or distributing funds to its residents is held to the highest possible standard of conduct,
regardless of where their corporate headquarters is located.
Right. It's entirely about consumer protection and market integrity.
Okay, so assuming a bank has meticulously mapped out exactly which services they want to offer, say they want to offer discretionary portfolio management, they've defined their cargo. What is the actual mechanism for getting permission to cross the border with it?
Well, it requires a highly formalized bureaucratic handshake. We call this defining the notified scope of the bank's activities.
Okay, notified scope. How does that handshake work?
The Luxembourg Home Authority, which is the CSSF, has to formally notify the French host authorities of the bank's specific intentions. And this is where the structural friction of the French system becomes really apparent.
Yeah, I noticed that in the texts, because France splits its regulatory oversight, right? The CSSF doesn't just talk to one counterpart in Paris.
Precisely. It entirely depends on what the bank is trying to do. If the Luxembourg bank wants to engage in traditional banking and insurance matters, the CSSF notifies the ACPR.
Okay, and what do they care about?
The ACPR is primarily concerned with prudential supervision, making sure the bank is financially sound and doesn't pose a systemic risk.
Makes sense.
But if the bank is venturing into financial markets, portfolio management, or anything touching investor protection, the AMF steps in. The AMF is the watchdog for market conduct.
Let me stop you right there because I have a practical question. If I'm a massive multinational Luxembourg bank looking at all this bureaucratic friction between the CSSF, the ACPR, the AMF, I'm looking for a shortcut.
Naturally.
And most major Luxembourg institutions already have a sister company or a group entity set up and fully regulated in Paris. So why can't I just piggyback off their French authorization?
A lot of people ask that.
Right. If we are all under the same massive corporate umbrella, why do I, the Luxembourg entity, need to go through this whole notification handshake?
It's a very logical deduction from a business perspective, but it is a massive legal trap.
Really?
Absolutely. The regulatory framework is completely blind to your corporate umbrella when it comes to cross-border servicing. The evaluation of control and authorization is strictly entity by entity.
So having a French subsidiary provides literally zero regulatory cover for the Luxembourg parent company.
Zero. If the Luxembourg institution is the one actually holding the assets, providing the commercial drive, or pulling the strings on the mandate, then the Luxembourg entity must possess the correct notified scope.
Wow.
Yeah, you cannot outsource your regulatory compliance to a sister company just because they share your logo. If the Luxembourg bank provides the service, the Luxembourg bank must hold the passport and the notification.
Okay, so there are absolutely no corporate shortcuts. Let's say we've cleared that hurdle, we've defined our services, the CSSF has notified the AMF, we are legally allowed to operate. But earlier you mentioned that France gets to dictate how we operate on their soil.
Yes, the third operational check.
Yeah.
This brings us to the concept of the host country's general good rules.
General good rules. What does that actually look like when the banker picks up the phone to call a prospect?
Well, even with a fully notified EU passport, you are stepping into a sovereign market. France enforces overarching behavioral rules designed to protect its social order and its consumers, and these apply to anyone operating within its borders, foreign or domestic.
So we're talking about things like local consumer protection laws overriding standard European practices.
Exactly. In practice, it means the Luxembourg Bank has to adhere strictly to French rules regarding pre-contractual information duties.
Okay.
And more importantly, they must comply with incredibly strict French regulations surrounding banking and financial solicitation.
Solicitation, meaning actively approaching clients.
Right. It dictates exactly how, when, and under what circumstances a banker can actively approach a potential client in France.
So if a Luxembourg banker wants to cold call a tech founder in Paris to pitch a new structured product, it doesn't matter if Luxembourg law is perfectly fine with that level of aggressive solicitation.
Not one day.
If French general good rules say that type of cold calling is illegal or heavily restricted, the French rule wins.
The host state's rules on market conduct always take precedence when interacting with clients on their territory. You are a guest in their market, You play by their rules of engagement.
This is all starting to paint a very clear and honestly quite intimidating picture. You have to classify the exact service, navigate a split regulatory notification system entity by entity, and then memorize and apply local French behavioral laws. It's a lot.
It is a massive operational burden.
But as I was reviewing the source material, there was one specific operational bottleneck that really stood out. It seems like the place where even the most sophisticated institutions accidentally blow up their compliance.
Ah, yes.
It all centers around the onboarding process.
You're referring to the KYC trap. Know your customer. This is, without a doubt, the most critical vulnerability for cross-border operations highlighted in our texts today.
So set the scene for us. What is the actual compliant framework a bank is dealing with when they sit down to open a new account for a French client? Because it's obviously not just making a photocopy of their passport anymore.
No, not at all. The underlying architecture is heavily dictated by European anti-money laundering and counterterrorism financing directives.
Right, the AML-CFT framework.
Yeah, you have this cascading series of regulations, starting with AMLD4, updated by AMLD5, and now being overhauled by the sweeping 2024 AML package.
And all of these EU directives run straight through the national law.
Right. Exactly. They manifest as rigorous customer due diligence duties within the French monetary and financial code.
So you have this massive, complex machinery designed solely to ensure the bank isn't facilitating financial crime. And banks spend, millions building out their standard KYC files to comply with this?
Hundreds of millions in some cases.
They verify identity, they check global watch lists, trace the source of wealth, assign a risk classification.
Yeah.
It is a highly robust process.
It is incredibly robust for its specific purpose. And that, right there, is exactly where the trap lies.
Okay, explain the trap.
The central thesis we have to pull from these sources is this. A Luxembourg bank cannot rely solely on its standard, robust Luxembourg KYC file to legally service a French client.
But wait, if I have perfectly verified that a client is not a money launderer, and I know exactly where their money came from, why isn't that enough?
Because proving a client is clean does not prove that your interaction with them was legal.
Oh, wow. Let's go back to an analogy here. Let's think about a high-end, exclusive nightclub in Paris.
Okay, I like where this is going.
The standard Luxembourg KYC file is like the bouncer at the front door, right? The bouncer checks the ID, ensures it's not a fake, verifies the person is of legal age, and makes sure they aren't on any banned lists.
Right. They assess the immediate risk and clear the person to enter.
Exactly. But they completely fail to record if the person was officially invited or how they heard about the club or if they're even legally allowed in the VIP section.
That is spot on. To truly capture the regulatory burden, it's not just about what the bouncer checks in the moment. It is about having a permanent auditable log of how that person got to the door in the first place.
So the standard file just proves the person is who they say they are, but it fails the cross-border test because it doesn't record the context of the invitation.
Precisely. If French regulators audit that account 3 years later, your standard KYC file will perfectly prove the client's identity, but it will completely fail to show that the interaction channel was legally controlled.
Right.
It won't prove that the specific investment service you sold them fell within your notified scope. And most critically, it completely fails to document the origin of the relationship.
The origin, meaning did the bank proactively solicit the client, or did the client approach the bank on their own initiative?
Yes. Reverse solicitation, where the client initiates the contact without any prior marketing from the bank, is a massive legal carve-out.
Ah, okay.
But if your standard file doesn't explicitly document how the relationship began, the French host authority will not give you the benefit of the doubt. They will just assume you actively solicited that client in France.
And if you didn't follow the French general good rules for solicitation when you supposedly did it, you are in breach of the law.
Exactly. If it isn't documented, it legally didn't happen.
So the bank might have done everything perfectly by the book. The client might have called them completely out of the blue. But without an auditable trail proving that origin, the bank is entirely exposed.
It's a terrifying reality for a compliance officer.
I can imagine. They are sitting on a perfectly clean KYC file that is simultaneously a regulatory time bomb.
It is a profound vulnerability.
Yeah.
Because standard onboarding files are built to fight financial crime. They're not built to evidence cross-border regulatory compliance. They're just two entirely different operational languages.
Which brings us to the necessary pivot. We've mapped the labyrinth, we've highlighted the traps. What is the actual practical fix for financial practitioners listening right now? Like, how do they avoid this KYC trap?
The sources point to a very specific operational deliverable. To survive a cross-border audit, every single French relationship requires a short, dedicated cross-border servicing file.
A dedicated cross-border file.
Yes. This must exist alongside or be fully integrated into the standard onboarding documentation.
So what does that actually look like in practice? If a compliance team is drafting this template tomorrow, what are the concrete scenarios this file has to capture?
It must be a comprehensive map of the interaction. First, it needs to establish the nature of the target. Is the bank interacting with an existing French client, or are they a pure prospect?
Because the general good rules around upselling an existing relationship are entirely different than the rules for cold pitching a new prospect.
Correct. Next, it must detail the geography of the interaction. Was the service negotiated entirely remotely from the Luxembourg office? Or did a private banker physically board a train and travel to France to shake the client's hand?
The moment the banker crosses the physical border to conduct business, the regulatory exposure shifts dramatically, right?
Oh, it does, completely.
Right.
The file also needs to document the acquisition channel. Was this client acquired through an intragroup referral, or were they swept up in a targeted digital marketing campaign aimed at the French market?
Got it.
And finally, it must explicitly list every single product or service involved. Is the bank providing simple deposits, Lombard lending, or a complex discretionary mandate? Every one of these data points proves that the bank is operating within its notified scope and adhering to host state rules.
It just sounds like an incredible amount of friction to establish a new account. But let's look at the reality of how these banking relationships evolve.
Okay.
Say a client comes to a Luxembourg bank strictly for basic deposit holding. The compliance team builds out this pristine cross-border file. The origin is documented, the scope is narrow, everything is perfectly legal.
Sounds good so far.
5 years pass. That same client sells a massive business, suddenly has 50 million euros in liquidity, and demands the bank build them a highly complex, structured product portfolio with discretionary management.
A classic scenario.
Does that original cross-border file still protect the bank?
Absolutely not. And this is where the compliance regime moves from a static onboarding task to a dynamic operational burden. The cross-border servicing file must be a living document.
A living document. Wow, so you can't just set it and forget it.
No, not at all. If the bank relies on a 5-year-old file that only clears them for deposit holding and they suddenly start executing discretionary trades, they are operating outside their notified scope. They are in breach.
So they have to update it.
The legal foundation must be re-verified, and the file must be updated before any service extension, before any new product launch, and before any new commercial action targeting that client. Compliance isn't a one-time hurdle.
It's a continuous state of compliance. The burden of proof never actually goes away. It just resets every time the relationship scales up.
Exactly. Cross-border compliance is the track you have to run on every single day.
Let's bring all these threads together. If you take away only one core insight from this deep dive today, it should be a complete reframing of what cross-border documentation actually means.
I agree completely.
Because in highly regulated overlapping jurisdictions like Luxembourg and France, your paperwork must do far more than just prove who your client is or where their money came from.
It must provide a bulletproof, ongoing audit trail, proving the precise nature, origin, and legality of every single interaction.
Right. You aren't just proving you have a driver's license. You are maintaining a permanent, verifiable log that you obeyed every single local speed limit every single time you drove the car.
And looking at the sheer density of this regulatory framework forces us to ask a much larger forward-looking question, I think.
What's that?
Well, we have just spent this entire analysis detailing the massive friction, the split regulatory notifications, and the meticulous auditing required to move capital between two founding members of the European Union.
Luxembourg and France. They share a border, they share the euro, and they share a commitment to the single market.
They're as highly integrated as two sovereign states can possibly be.
Yeah, that's very true.
So, if the regulatory friction is this intense and this deeply tied to physical geography here, what happens in the next decade?
Oh, that's true.
How will the increasing digitalization of global finance, combined with the explosive rise of borderless digital nomads, force regulators to completely rethink these frameworks?
Because the concept of a border is blurring.
Exactly. When a high-net-worth client's physical location shifts across 3 different tax jurisdictions in a single year, but their wealth remains entirely digital, how does the rigid geographic notification system of a CRD YOFI or MIFID passport survive?
That is the ultimate tension, isn't it? The regulators are trying to build static geographic walls around a financial system that is becoming fundamentally borderless. It's going to be fascinating to see which side breaks first.
It really will be.
But for today, we've successfully navigated the labyrinth. We've mapped the legal tiers, we've highlighted the split notification systems, and hopefully we've given you the operational blueprint to avoid the KYC trap. Thank you so much for joining us on this deep dive. We'll see you on the next one.